Hi folks, welcome to this short lecture on fractional share rights. In this lesson we're going to show you or explain to you how they work theoretically and then provide you with a short example and then a longer example. So let's begin. Sometimes when a company declares a share or a stock dividend, it can result in partial or fractional shares being created. So we have a little example here for you. And so let's say in this example here, if you have 50 shares, that's you own. Let's say a company declares a 5% share dividend. Then you're going to get an extra 2.5 shares because we'll take the 50 shares you have, multiply them by 5%, and you're going to get 2.5 more shares. So in total, you'll now have 52.5 shares. But we know that we can't give you a half a share, so we refer to this 0.5 or this half share as a fractional share. So the question then becomes, how do you get something for that half a share? Well, in some cases, the company might decide to issue those who have these fractional shares what we call a right. And this right would allow you to buy other fractional share rights from other investors that have rights in order to make up the number of shares, full shares, that you want to buy. The only problem with these fractional share rights is that they usually take, they're time limited, I should say. So you have a particular time within which to exercise these rights, or else they're going to lapse or expire. So that's one of the issues with that method, but in any case, let's just take a look at an example so you can see how these fractional shares can be built up over multiple shareholders. And then what we're going to do is we're going to do an example to show you what the options would be from an accounting perspective to handle the fractional share rights. So let's say, for example, we have 5 shareholders, and each shareholder has the number of shares as indicated in this column right here. So let's say you're shareholder 1. You can be any shareholder you want, but let's put you as number 1. You know that you're getting a 5% share dividend, so you're going to have 2.5 new shares for a total of 52.5 shares. Another shareholder has 30 shares, which is going to give them new shares of 1.5, and they're going to have 31.5 shares. Another shareholder has 52 shares. So when we multiply that by 0.05, this shareholder is going to have 2.6 shares, or 54.6 shares. And somebody who has 81 shares is going to have 4.05 more shares to have 85.05 shares. And the last little guy here, 47 shares times 0.05 will get that person an extra 2.35 shares, meaning that his or her total shareholdings will be 49.35. Well, one of the things you notice here is we can't give you, as we set up here, we can't give you half shares or 0.6 of a share or 0.05 of a share or even 0.35 of a share. But you do notice that the total number of new shares that we're going to issue are 13. And it's these 13 shares that we would use to value the amount of the share dividend that the company is going to distribute. But you know from previous courses, when you have a share dividend, that's where the debit would go to. But we would normally credit common shares when those shares are issued. But we can't issue fractions of the shares, because if we add up all these little highlighted yellow guys here, we're going to find that these guys total to 2 shares. If you add up the fractions, that tells me all these fractional shares add up to 2 shares. So that means I can issue, as the company, if I wanted to, 11 shares at the date of distribution or issuance of that common share dividend. But then I'm going to have all these fractional shares totaling to 2. Well, the one thing you got to remember is these all belong to different shareholders, right? So what you sometimes find is that some companies will value these fractional shares in 2 different ways. But before we get to the different way, let's just figure here that each share dividend that we're going to issue, the market value at the time we're going to issue the shares is $34 a share. But don't forget, we can't issue these partial shares, so we issue them as fractional share rights, which give people the option to go out and buy all those other fractional shares up to make as many full shares as they want so that they can get their shares. So let's have a look at how that might work, or what the accounting options are. But first of all, let's make sure that you understand, I just have a spelling error here, share fractions. Let's save that. Okay, Now, I just explained this part to you, that all those little yellow fractions add up to two full shares, right? But again, they're being held by different shareholders. So the first option the company has is to value those rights to buy up those fractional shares, which total 2 shares. We give them the right to do it, so we can set up, as the corporation who's issuing the share dividend, a contributed capital account for the value of those fractional share rights. And those rights would entitle you to buy your partial shares to total up to a number of full shares. And these are part of contributed capital in the shareholders' equity section of the balance sheet. So therefore, if I was to make a journal entry at the date of declaration and issuance, so I'm going to assume declaration date and issuance. So I'm assuming here that the date I declare is the date I issue or distribute the shares. I'm going to debit the share dividend for the full amount of the new shares being created, even though some of these are fractional shares. It doesn't matter. It's still part of the value of the share dividend. And again, we always value those at the market value at the date they're declared. I'm going to credit the common shares, but notice I've only got 11 full shares that I can issue, right? At $34 a share, which again is the market value. And the balance, those other partial shares that make up 2 shares, that's the value of my fractional share rights, and I'm valuing them at $34 for each full share that those fractions create, and crediting that contributed capital on fractional share rights for $68. And this would show up in the contributed capital section of the balance sheet in the equity section. The other option I have as the company is it's so much simpler and quite common to just credit cash for the value of those fractional shares. So in other words, each of these people that has 0.5 of a share, 0.5 of a share, whatever, they would get the dollar value that this equates to, right? So they would get this fraction times 34, this fraction times 34, this fraction times 34, okay? And all those fractions are going to add up to 68, right? So, or sorry, 68. So in any case, that's how I value it. But in this case, I would credit cash, all right? So now, if you added up all of these partials and took 0.5 times 34, that would give you 17 plus 17. And if you did the math on the rest of them, 0.6, that would give you, let me see if I did it. Yes, I did. That would give you $20.40, I think, yeah. So 0.6 times 34, and this 0.05 would give you $1.70, and this 0.35 would give you $11.90 if you multiplied that by $34. So each of these guys, if you added up all those fractions and equated them into dollars, you would see that that totals 68. So you can try doing that yourself and make sure that that works out for you. Okay? So now, if you want to pause the video here just to check that out, to make sure that when you multiply each of these highlighted pieces, okay, by 34, okay, $34 a share multiplied by the partial shares, you are going to get 68. Okay, so if you want to take a few minutes just to validate that, you go ahead and stop the video. In the meantime, I'm going to take a look at another example on how we can use this concept and work on some independent situations. So let's have a look at this question where a corporation was authorized to issue unlimited common shares, and right now they have 452,000 common outstanding on March the 8th, 2000x2, and they've got the amount of paid-in capital, or the amount that the shareholders gave them to buy those 452,000 shares, is $1,367,000. Now, at that time, the board declared and issued a 5% share dividend, and that share dividend was valued at $4.50 a share. So now, we have some independent situations here that we want you to make journal entries for, okay? So none of these are dependent on the ones previous. So now it says here, if the share dividend is declared and issued on March the 8th and all the shares are distributed, well, this is something you should know. So we would debit our stock dividend for the value of the share dividend. So we're going to take the total number of shares we have, multiply it by the value of the share dividend so we can calculate how many new shares are created, okay? And that's going to be 226,000 or 22,600, sorry, times $4.50 because that's the market value at the date they were declared. So we're going to debit the share dividend account, and or you could do it directly to retained earnings because all dividends, cash or share dividends, are all closed out to retained earnings, and we're going to credit our common shares for 101,700. Now, let's assume that instead the share dividend is declared and issued March the 8th, and it results in some whole shares being created, but it also results in some fractional shares that equate or add up to 1,600 shares. This is kind of like our previous example where we had all those little fractions adding up to 2 shares. In this case, all those little part shares add up to 1,600 full shares. Okay, so now, remember I told you earlier that if a company decides to issue fractional share rights, that usually these rights have an expiry date by which time they have to be exercised. They're kind of like coupons when you go to the store, right? And you have a coupon and it expires at a certain date. These work the same way. But now it says they expire on April 30th, but at that time, people went out there, bought some more fractional shares or fractional share rights, and had enough. So 70% of those rights were actually cashed in for shares or traded in for shares, full shares, but the other 30% weren't, so they expired or lapsed. So what would this journal entry look like? Well, the debit is the same as it was up here because the value of your share, your stock dividend, is still going to be the total number of shares outstanding times 5%, which is going to give us 22,600 shares, and we're going to multiply it by the market value to give us the total value of the share dividend. The only difference here is that the company is now issuing fractional share rights. So the first thing you can do is I would value the full shares. Now don't forget, of the 22,600 shares that we would normally issue, 1,600 of those shares represent fractional shares. So we have to value those separately because it says they're using rights in here. They're using fractional shares, so they're using rights. So to value the common shares, the full shares, we're going to deduct the 1,600 shares that represent fractional rights. So we're going to get 21,000 full shares being issued at $4.50 a share, which would give you 94,500. So those fractional shares that total 1,600 shares, we're going to set up as contributed capital from fractional share rights. So this is your contributed capital account. Okay, and in fact, I'll just call it that. Okay, I'm going to have to change this up just a tad, but no problem. All right. Just to make sure we're consistent with the terminology that your text is using. So I'll change that to contributed capital. And the value, you can actually plug it, but you can value it too. It's just the other 1,600 shares from this 22,600 that are fractional, right? So in any case, that's going to be 7,200. And you can do the same thing here. Now, don't forget here, what they said is that on April the 8th, what happened is that of this 7,200, or sorry, April 30th, I should say, 70% of those fractional share rights were exercised. So now that means that we no longer have contributed capital on fractional rights outstanding because some people went into the marketplace, bought up all these little rights, and got full shares. So by the time April 30th came around, 70% of the rights were exercised, but 30% lapsed. So what that means is that we no longer have any fractional rights outstanding because they were either exercised or they weren't. They expired. So of the ones, the fractional share rights that we had, 70% of them were exercised and traded in for full shares. So 70% of this is going to give you $5,040 of new share equity. All right, and that means that the number of, or the amount of contributed capital that lapsed, of course, is going to be $2,160, the other 30% of this. So you notice that this is a contributed capital account, and this will stay on your balance sheet indefinitely. Why? Because it's value that you gave the shareholders that they never took advantage of. They chose, for whatever reason, not to get the benefit of their rights. So that's like equity that they were entitled to that they didn't claim. So it remains with you. So if you look at it this way, you're just taking it out of one contributed capital account. I'm just going to copy that and put it there just to be consistent. You're going to take it out of here, right? Because you no longer have any fractional share rights outstanding, because by April 30th they all expire if they're not redeemed for full shares. And in this case, you issued your shares, 70% of those rights were exercised, but the balance were never exercised. So that's like equity you didn't have to pay out, so it stays with you. So we just reclassify it as lapsed or expired share rights, and there's 2,160. Okay? So now, that's how you handle it if you issue rights. What if you didn't issue share rights? Then it's a lot easier. What would happen now is, say for example, you issued the shares, all right, on the same date that you declared them, but instead of issuing share rights like you did up here, share rights, what you decided to do was just pay them out in cash. So you gave every shareholder their entitlement of fractional shares, but at $4.50 a share, right? So in total, you paid out in cash $7,200. So again, what that means is that instead of issuing fractional share rights and impacting your contributed capital, you took the 1,600 full shares that those share rights equated to, and you just paid them out. And so you gave them $4.50 a share. All right, and then you issued your common shares for the full 21,000 shares. All right, don't forget, this number here is still going to total 22,600 shares. It just means 21,000 were full shares, 1,600 were fractional, that totaled up to 1,600 shares, right? But we're paying them cash for it. And this, of course, is the more common method to use in this day and age, because shareholders get a little upset when you keep their equity from them, right? So in this case, everybody gets what they're entitled to right off the bat. Okay, so now if you feel you need to take a break to review these examples so far, you go ahead and do that. I'm going to go ahead to the last example here, which is a little bit different and reminiscent of what you might have done in a prerequisite course when you declare, but you issue the shares at a later date. In this case, we're still going to have fractional shares created. All right, but in this case, all we're saying is that they weren't issued until April the 8th. So the only thing that makes this example different from the second example is the fact that the shares are issued at a different date. So now if we have a look at this example, we're going to debit our share or stock dividend, or retained earnings if you prefer, for the full value of the number of shares we currently have outstanding times the value of the share dividend, which will give us 22,600 shares, times the market value of the shares at the date we declare it, which is 101,700. But instead of crediting common shares, because they're not issued yet, they don't get issued until April the 8th. So on March the 8th, we're going to credit another equity account known stock dividend or share dividends distributable for 101,700. This again is a shareholders equity account. It's not a liability account. If we were issuing, or if we were declaring and paying at a later date a cash dividend, then we would credit a dividend payable account. But we're not. Because it's all related to share issuance, we're going to credit another equity account called stock dividend distributable, and it's a shareholders equity account. Okay, now if you're not sure about these share dividends that are issued at a different date than the date they're declared, you may want to go back and review your prerequisite course. Now, here we are, April the 8th, and what happens April the 8th? Well, April the 8th, we're going to issue the shares, but don't forget, okay, so now where were we when that phone rang? Anyway, Again, if you go back to your prerequisite course, I'm sure you'll remember, or you can locate content on your stock dividend distributable. If not, just trust me, it's a shareholders equity account. Now, at the time when we actually distribute or issue the dividend, what are we going to do? Well, we're going to issue the common shares for the full value of the share dividend, but don't forget there's 1,600 that are fractional shares that total up to 1,600 full shares. So we're going to value those separately as contributed capital on those fractional rights. Okay? So I'll just put this back in here again. So that's your contributed capital on those fractional rights. All right, and that's a credit of 7,200. Again, how did we do that? Well, don't forget we had 1,600 shares. That's the number of partial shares. There's partial shares that total to 1,600 full ones times $4.50. And this is the value or the number of full shares that you're going to issue, okay, that do not have any fractions attached to them. So you have your 22,600 less these little fractional shares that total 1,600. So that's going to give you 21,000 full shares right off the top at $4.50. So now, what's going to happen on April 30th? Okay, that's the date at which they lapse, and what we noticed that at lapse date, 70% of them were redeemed and 30% expired. So we're going to remove the entire contributed capital on the common share fractional share rights that are outstanding because those rights are no longer available. 70% of them were exercised and 30% expired. So we no longer have any fractional rights outstanding because 70% of them were exercised and traded in for full shares, and the balance just lapsed. And remember, we said earlier that this represents equity that the investor was entitled to, but they never exercised. So that's like equity that hasn't been paid out in any way, either through cash or shares to the investors, because the investors let them lapse. So it stays with the company as $2,160 of value. So that concludes our presentation on fractional share rights.